Did you know the top 1% own 54% of all stocks and mutual funds in America? That's right. While most of us are following mainstream advice about 401ks and index funds, the ultra-wealthy are playing an entirely different game. In this video, I'm going to reveal the exact investment strategies billionaires use that regular financial advisors never talk about. You'll learn how the 1% leverage AI technology and alternative investments to build generational wealth, and how you can apply these same principles starting today. The Wealth Gap Reality Check: why traditional advice isn't working. Did you know that following standard financial advice might be keeping you stuck in the middle class? Let's look at what's really happening. We're living through the greatest wealth transfer in human history, yet somehow the gap between the rich and everyone else isn't shrinking. It's exploding. Despite having more financial education at our fingertips than ever before, middle-class wealth has stagnated while the ultra-wealthy have been on an absolute tear. The numbers are staggering. Since 2020, the top 1% have increased their wealth by a jaw-dropping 42%, while the bottom 50% saw gains of just 18%. In dollar terms, that difference is even more dramatic. We're talking trillions versus billions. And get this, the richest 1% now own more wealth than the entire middle class combined for the first time in American history. But wait, aren't we all following the same financial playbook? Save 10% of your income, max out your 401k, invest in low-cost index funds, and avoid debt like the plague? This is the gospel preached by most financial gurus, and it's the advice most of us try to follow. Here's where things get interesting. If you compare the investment returns of someone dutifully following this traditional advice versus the ultra-wealthy over the past decade, it's like they're playing entirely different games. While index fund investors celebrated an average 10 to 12% annual return during the bull market, many in the 1% saw returns of 20 to 30% or higher through strategies most people never hear about. The truth is that traditional financial advice, the kind you get from most books, blogs, and certified advisors, isn't designed to make you wealthy. It's designed to make you stable. There's a massive difference between financial stability and true wealth creation, and this distinction is deliberately blurred in mainstream financial education. Think about it. The standard advice focuses almost exclusively on saving money and avoiding mistakes. It's defense-oriented. But the ultra-wealthy play offense. They don't just preserve capital, they aggressively grow it through sophisticated strategies that most financial advisors never mention to their average clients. Take the 401k, for example. While it's presented as the gold standard for retirement planning, it's actually a relatively recent invention from the 1980s. Before that, pensions were the norm. The 401k effectively shifted the responsibility of retirement planning from employers to employees, creating a massive industry of fund managers who collect fees regardless of performance. Meanwhile, the wealthy use completely different vehicles like family offices, specialized trust structures, and alternative investments that offer far more control and tax advantages. Even the invest in index funds advice shows its limitations when you look closer. Yes, low-cost index funds beat most actively managed funds, but they also guarantee you'll never outperform the market. You're signing up for average returns by definition. The wealthy don't aim for average. They pursue asymmetric opportunities where the potential upside far outweighs the downside risk. The psychological differences in how wealthy people approach money decisions versus average investors are equally striking. Most financial advice for the masses focuses on budgeting, cutting expenses, and slow, steady investing, essentially a scarcity mindset. The ultra-wealthy operate from an abundance mindset, focusing on expanding income streams, leveraging assets, and capitalizing on market inefficiencies. Consider how different educational systems serve different wealth classes. Public school financial education, when it exists at all, focuses on basic budgeting and avoiding debt. Private schools for wealthy families teach investment theory, business formation, and wealth preservation strategies. By the time most kids from wealthy families reach adulthood, they've already been exposed to sophisticated financial concepts most people will never learn. Let me give you some concrete examples of how standard financial education deliberately leaves out advanced strategies. You'll rarely hear mainstream financial advisors discuss how to use strategic debt as a wealth-building tool, rather than avoiding all debt. Legal tax minimization strategies beyond basic retirement accounts. How to access private investment opportunities not available to the general public. The power of arbitrage and asymmetric risk-reward opportunities, using entity structures to protect and grow wealth. The reality is that there's essentially a hidden playbook used by the wealthy, and it contains strategies and approaches that go far beyond the simplified advice fed to the general public. So why do these investment strategies of the 1% remain hidden from average investors? There are several reasons, and none of them are conspiracy theories. They're just uncomfortable truths about how our financial system works. First, many advanced strategies require substantial capital to implement effectively. When you have millions to invest, you can access opportunities that simply aren't available or practical at smaller scales. Second, the financial services industry profits enormously from maintaining the status quo. Collecting management fees from millions of 401ks is far more profitable than helping people build true wealth. Third, and perhaps most importantly, there's a pervasive belief among the wealthy that financial sophistication is a competitive advantage best kept within their circles. It's not malicious, it's just human nature to protect advantages. Financial education companies, advisors, and institutions are incentivized to keep their most profitable clients happy, not to democratize their best strategies. The good news? The internet is slowly dismantling these information barriers. More people than ever are gaining access to strategies once reserved for the elite. But information alone isn't enough. You need to fundamentally shift how you think about money, investing, and risk. The psychological edge, how the 1% think differently about money. That fundamental shift in how you think about money? It's worth about 7% per year in returns. When the market tanks and your stomach is doing backflips, the ultra-wealthy are mentally wired to see dollar signs instead of disaster, and that psychological difference might be the biggest wealth gap of all. Access to information is great, but what happens in your brain when you're making financial decisions? That's where the real money is made or lost. The research is clear. Emotional decision-making costs average investors between 4 to 7% in annual returns. Think about that. Your portfolio could be 7% larger every year simply by changing how your brain processes market fluctuations. What's fascinating is that this psychological edge isn't some secret talent you're born with. It's a learned skill that separates the ultra-wealthy from everyone else. And it starts with understanding how your brain naturally sabotages your investments. Ever notice how losing $100 feels way worse than winning $100 feels good? That's loss aversion in action. Our brains are literally wired to feel the pain of losses about twice as intensely as the pleasure of equivalent gains. For most investors, this creates a destructive pattern, holding on to losing investments too long, hoping they'll recover, while selling winners too early to lock in gains. The wealthy have trained themselves to overcome this instinct. During the 2020 market crash, this psychological difference played out in real time. While millions of everyday investors panicked and sold at the bottom, what were wealthy investors doing? They were buying. They weren't smarter. They just processed the situation differently. Instead of seeing disaster, they recognized opportunity. The same pattern repeated in 2022 as markets faced significant downturns. Average investors frantically sold, locking in their losses permanently. Meanwhile, wealthy investors maintained their positions or even increased their investments, displaying strategic patience that would ultimately reward them when markets recovered. This isn't just anecdotal. Wealthy investors openly acknowledge the role psychology plays in their success. In fact, 65% of high net worth individuals recognize that their own biases impact their decision-making, especially during market volatility or major life events. This self-awareness gives them a crucial advantage. You can't overcome a bias you don't recognize. Think about confirmation bias, our tendency to seek information that confirms what we already believe. When the market starts dropping, average investors often look for news that confirms their fears, creating a downward spiral of panic. The wealthy do the opposite. They deliberately seek out contradictory viewpoints and challenge their assumptions. This diverse perspective allows them to make more balanced decisions based on complete information rather than fear. The wealthy also think in completely different time frames. While most investors obsess over quarterly results, the ultra-wealthy are planning across decades and even generations. Market crashes that seem catastrophic in a one-year window look like minor blips when you're investing with a 20-year horizon. This longer perspective naturally leads to calmer decision-making. Take Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful. It sounds simple, but it's psychologically difficult to execute. When everyone around you is panicking, your brain's survival instincts kick in, urging you to follow the herd. The wealthy have trained themselves to override this instinct and act rationally when everyone else is emotional. Billionaire investors consistently emphasize rational decision-making and data analysis over emotional responses. They use advanced analytics to guide their strategies, ensuring decisions come from data rather than fear or greed. When markets crashed in 2020, they relied on their understanding of market cycles to make informed choices, buying undervalued assets while others panic sold. Another powerful psychological technique the wealthy use is mental compartmentalization. They're able to separate market volatility from their emotional state. A 20% market drop doesn't ruin their day. It's simply information to be processed. This emotional detachment allows for clearer thinking when stakes are highest. The wealthy also practice the principle of mental accounting differently than average investors. Most people categorize money differently based on where it came from, a tendency that can lead to poor decisions. Wealthy investors train themselves to treat all money as interchangeable and part of a cohesive strategy, avoiding the psychological traps that come with emotional attachments to certain investments. Here's something that might surprise you. Many wealthy investors deliberately expose themselves to small failures early in their careers. These calculated risks build psychological resilience, training their brains to process losses without emotional overreaction. It's like building an immunity to the panic that destroys wealth during market crashes. Consider the psychological concept of status quo bias, our natural tendency to keep things as they are, even when change would benefit us. Average investors often hold on to legacy investments or familiar companies out of comfort, even when data suggests better opportunities elsewhere. The wealthy consciously fight this bias, continuously reevaluating their positions based on current conditions rather than past decisions. Perhaps most importantly, wealthy investors understand that their brain is both their greatest asset and potentially their worst enemy. They invest significant time in financial education, not just to learn strategies, but to understand and overcome their own psychological tendencies. Many work with coaches or advisors specifically to identify and counteract their personal biases. What's the practical takeaway here? Start treating your investing psychology as seriously as you treat your investment picks. Track your emotional states when making financial decisions. Create systems that protect you from yourself, like pre-committed investment plans that continue during market downturns. Build a personal, cooling-off period before making any major financial decision during times of market stress. Remember that wealthy investors aren't emotionless robots. They feel the same fear and uncertainty everyone does during market turmoil. The difference is they've trained themselves to recognize these emotions as signals to be analyzed, rather than commands to be followed. They've built decision-making processes that account for their human tendencies and protect them from impulsive actions. AI revolution: how the wealthy use technology to make better investment decisions. While you're checking basic stock charts on your free trading app, the ultra-wealthy are using AI systems that process 2.5 quintillion bytes of data daily to spot opportunities completely invisible to the human eye. This isn't science fiction. It's the reality of modern investing, where artificial intelligence has created an unprecedented information advantage for those who can afford it. Think about what happens when you research a potential investment. You might check the company's website, read a few articles, maybe look at their latest earnings report. Now imagine having an AI assistant that has already analyzed every earnings call transcript, news article, social media mention, and financial statement about that company and 10,000 others before you've even opened your laptop. That's the technological edge the 1% enjoy every single day. The gap between retail and wealthy investors isn't just about having more money to invest. It's about having superior information processing capabilities. While you're comparing PE ratios, family offices and hedge funds are deploying sophisticated AI tools that can identify subtle patterns across global markets, predict shifts in consumer behavior, and detect market anomalies in milliseconds. One of the most powerful technologies in the Wealthy Investor's Toolkit is natural language processing, NLP. These systems can instantly analyze and interpret human language from countless sources. Imagine an AI system that listens to every earnings call, reads every financial report, and scans millions of news articles and social media posts about companies you're interested in. It then extracts the valuable insights, identifies patterns in language that might signal future problems or opportunities, and delivers actionable intelligence that would take human analysts weeks to compile. When the CEO of a company uses slightly more negative language than in previous calls, or when customer sentiment on social media begins to shift, these AI systems flag these subtle changes immediately. This gives wealthy investors a crucial early warning system that most retail investors simply don't have access to. Take hedge funds like Renaissance Technologies and Two Sigma, which employ teams of PhD mathematicians and data scientists to build predictive models that process market data at speeds impossible for humans to match. These models can identify subtle correlations between seemingly unrelated economic indicators, spotting opportunities months before they become apparent to the average investor. The ultra-wealthy also use AI-powered sentiment analysis to gauge market psychology in real time. These systems classify the emotions behind investment decisions into categories like positive, negative, or neutral. When you're still trying to figure out if a market dip is temporary or the start of something bigger, wealthy investors already have AI systems telling them precisely how the collective market is feeling and what that likely means for price movements in the coming days and weeks. This predictive capability helps the wealthy prepare for emotional market shifts before they happen. While average investors are reacting to news, the 1% are positioning themselves based on what their AI tools tell them is likely to happen next. It's like having a financial crystal ball that gives them a 30-minute head start on every market move. The integration of AI into wealth management isn't just a fringe practice, it's becoming the industry standard at the high end. Nearly half of wealth management firms are currently using AI in some capacity, and a whopping 73% plan to increase their AI adoption at the enterprise level within the next couple of years. Why? Because it works. These AI systems excel at risk management, analyzing vast amounts of both structured and unstructured data in real time to help wealthy investors understand exactly what risks they're taking and how to mitigate them. While you might be wondering if a stock is too risky based on its recent volatility, wealthy investors have AI tools calculating precise risk exposures across their entire portfolios, factoring in hundreds of variables from global economic indicators to supply chain disruptions in specific industries. The technology advantage extends to portfolio optimization as well. Major financial institutions like HSBC have developed platforms that use generative AI to optimize asset allocation and provide investment insights. These systems can continuously monitor market conditions and dynamically adjust investment strategies based on real-time data, something that would require a small army of human analysts to accomplish manually. What does this all mean in practice? It means that wealthy investors often see opportunities that remain completely invisible to everyone else. When an AI system detects a subtle shift in consumer behavior that will benefit a specific company 3 months from now, wealthy investors can position themselves early. By the time you're reading about the trend in the financial news, they've already captured much of the upside. This technological edge isn't just about making better picks, it's about making decisions faster. In today's markets, speed is often as important as accuracy. AI systems can process information and execute trades in milliseconds, allowing wealthy investors to react to news and events before prices fully adjust. While you're still reading the headline, they've already made their move. The use of AI also helps wealthy investors overcome the psychological biases we discussed earlier. By relying on data-driven insights rather than gut feelings, they can remain disciplined when markets are chaotic. Their AI systems don't feel fear or greed. They simply identify patterns and opportunities based on cold, hard data. One particularly powerful application is using AI to identify what insiders at companies are doing with their own stock. These systems can detect unusual patterns in insider buying or selling that might signal future company performance, giving wealthy investors another early warning system that most retail investors lack. Family offices, the private wealth management firms that serve the ultra-wealthy, are increasingly building proprietary AI systems tailored specifically to their clients' investment preferences and risk tolerances. These custom-built tools provide personalized insights that go far beyond the generic advice available to average investors. The information advantage becomes even more pronounced in private markets. AI systems help wealthy investors identify promising private companies long before they go public, analyzing everything from talent movement between companies to patent filings to social media engagement metrics. This allows them to invest at much earlier stages, capturing exponentially more upside than investors who wait for the IPO. But the most sophisticated wealthy investors aren't just using AI, they're investing heavily in it. They recognize that artificial intelligence represents one of the greatest wealth creation opportunities in history, and they're positioning themselves accordingly. They're backing AI startups, investing in specialized AI-focused venture funds, and acquiring stakes in companies developing the next generation of financial technology. The AI revolution in investing isn't slowing down, it's accelerating. As these technologies become more sophisticated, the information advantage enjoyed by wealthy investors continues to grow. The firms that develop these technologies primarily serve institutional clients and high-net-worth individuals. Megatrend Investing, where the smart money is flowing in 2025. That technological divide we just discussed is just the beginning of how the ultra-wealthy maintain their edge. While most of us frantically scroll through quarterly earnings reports, the elite are quietly positioning billions into 5 massive global shifts that won't fully materialize for 5 to 10 years. These aren't just casual investment picks, they're strategic bets on which industries will dominate our economic future. Let me introduce you to what the wealthy call Megatrend Investing. This approach ignores day-to-day market noise and instead focuses on identifying unstoppable forces reshaping our world. Think about it. Would you rather chase the latest meme stock or position yourself in front of massive, inevitable changes that will unfold over the next decade? The difference is striking. Average investors get caught in the daily drama of market fluctuations, checking their apps constantly for small movements. Meanwhile, billionaire investors are looking at demographic shifts, technological revolutions, and resource limitations that create persistent tailwinds for certain sectors. It's like the difference between watching the waves hit the shore versus understanding the massive tidal forces that cause them. The numbers tell the story. Did you know that Blackstone, one of the world's largest investment firms, just dropped $10 billion on a single data center acquisition? That investment has since grown its lease portfolio more than 9-fold. This move wasn't about next quarter's profits, it was about securing critical infrastructure for the AI economy of tomorrow. Speaking of AI, let's break down the first megatrend the ultra-wealthy are betting on. The demand for artificial intelligence infrastructure is expected to require an estimated $2 trillion in global digital infrastructure investment by 2030. That's not just server farms, it's the entire ecosystem needed to support our data-hungry future. But here's where wealthy investors think differently. They're not just buying obvious tech stocks. They're acquiring the underlying infrastructure that powers AI, specialized data centers, semiconductor manufacturing facilities, and the companies developing custom AI chips beyond the household names. They're targeting the picks and shovels of the AI gold rush rather than panning for gold themselves. The second megatrend is life sciences and biotechnology. Blackstone and other major investment firms are financing innovative medicines and medical technologies that address fundamental human challenges. Take their investment in Alnylam, which developed Leqvio, a groundbreaking drug that significantly lowers LDL cholesterol. The wealthy aren't just looking for the next blockbuster drug. They're investing in platforms and technologies that can create entirely new categories of treatments. The longevity sector is particularly attractive to billionaire investors. As our global population ages, there's unprecedented demand for technologies that extend healthy lifespans. This isn't just about living longer, it's about the massive economic opportunities in everything from targeted therapeutics to preventative health technologies. The wealthy are quietly accumulating stakes in companies working on cellular reprogramming, gene therapy, and regenerative medicine long before these become mainstream investment themes. The third megatrend centers on what I call the experience economy. There's a fundamental shift happening in consumer behavior away from accumulating physical goods toward meaningful experiences. Blackstone recognized this early, investing in companies like Merlin Entertainments and Great Wolf Lodge. This isn't random, it's a calculated bet on how younger generations prefer to spend their discretionary income. What makes this trend particularly powerful is its resilience to digital disruption. While many physical products can be replaced by virtual alternatives, experiences by definition require physical presence. The wealthy are positioning themselves in premium travel, adventure tourism, wellness retreats, and immersive entertainment, all areas that command premium pricing and attract consumers who value experiences over possessions. The fourth megatrend focuses on energy transition and resource scarcity. The shift toward renewable energy, storage solutions, and grid modernization represents one of the largest capital redeployments in history. But unlike retail investors who might buy a handful of solar stocks, wealthy investors are focusing on the critical infrastructure and materials that enable this transition. They're acquiring interests in everything from rare earth mining operations to battery technology patents to grid-scale energy storage projects. They recognize that regardless of which specific technologies win out, there will be enormous demand for the underlying resources and infrastructure that make them possible. It's a sophisticated approach that looks at the entire value chain rather than just the most visible companies. The fifth and final megatrend revolves around demographic shifts, particularly the rise of emerging markets like India. Blackstone has identified India's evolution as one of their highest conviction investment themes. They're not just buying Indian stocks, they're making massive direct investments in everything from logistics networks to office parks to consumer services businesses that benefit from India's growing middle class. This approach to demographics extends beyond just geographic positioning. Wealthy investors are also focused on the great wealth transfer happening as baby boomers pass an estimated $30 to $40 trillion to younger generations over the next 2 decades. This massive shift is creating opportunities in wealth management firms that incorporate behavioral insights and personalized financial solutions that appeal to younger investors. What's fascinating about all these megatrends is how interconnected they are. The AI revolution requires massive energy resources. Demographic shifts influence healthcare demands. The experience economy creates new infrastructure requirements. By understanding these connections, wealthy investors create diversified but thematically aligned portfolios that benefit from multiple tailwinds simultaneously. The ultra-wealthy don't just identify these trends, they position themselves to profit from them in ways that most retail investors can't access. While you might buy publicly traded stocks related to these themes, the truly outsized returns often come from private investments made years before companies go public. For example, the democratization of alternative investments is creating significant opportunities that most investors miss. Assets under management in the alternative space are expected to reach $19.6 trillion by 2028. Private equity and venture capital focused on these megatrends consistently deliver superior returns compared to public markets, but traditionally required millions just to get in the door. The approach also involves sophisticated timing. The elite investor class doesn't wait for megatrends to become obvious. By then, much of the opportunity is gone. Instead, they position capital when these trends are just emerging, often facing skepticism from mainstream analysts. This contrarian timing allows them to acquire assets at valuations that reflect current conditions, rather than future potential. Take climate adaptation infrastructure as an example. While much attention focuses on reducing carbon emissions, forward-thinking investors are already acquiring assets that will become essential as climate impacts intensify. Specialized insurance companies, water rights, coastal protection technologies, and resilient agricultural systems. These investments may seem premature today, but will become increasingly valuable as climate challenges intensify. Beyond stocks and bonds, the alternative investment playbook. While elite investors position themselves for climate adaptation, there's a much deeper secret hiding in plain sight. Ever wondered why billionaires barely flinch when market crashes send average investors scrambling for the exit? The answer might shock you. The ultra-wealthy keep only 21% of their wealth in public stocks. That's right. The very investment vehicle where most Americans park nearly everything is just a small slice of the billionaire portfolio pie. This massive allocation difference isn't just interesting trivia, it's the cornerstone of how the 1% build and preserve generational wealth. While your financial advisor pushes the traditional 60-40 stock-bond split, the wealthy are playing an entirely different game with alternative investments that most people have never even considered. Let's break down what's really happening in those elite portfolios. Recent studies show that ultra-high net worth individuals have dramatically increased their allocation to alternative investments, growing from 13% to 15% in 2024 alone. But that barely tells the full story. When you include all non-traditional investments, the wealthy have positioned nearly 80% of their capital outside conventional public markets. The question is, why? The answer lies in the exceptional performance of these alternative asset classes. Take private equity, for example. These investments have consistently delivered annualized returns between 10% and 20% over 7 to 10-year periods, significantly outpacing what's available in public markets. This outperformance isn't just occasional, it's structural and persistent. The private equity advantage comes from a fundamental difference in how these investments work. Unlike public stocks, where you're buying small pieces of established companies at market prices everyone can see, private equity allows investors to acquire controlling interests in companies, implement operational improvements, and exit at a premium. This hands-on approach creates value that simply isn't possible through passive public market investing. What's particularly interesting is how rapidly this sector is growing. The total assets under management in alternative investments nearly doubled from $7.4 trillion in 2017 to a staggering $14.7 trillion in 2022. And that growth isn't slowing down. Projections suggest the market will reach $19.6 trillion by 2028. This explosion of capital isn't happening by accident. It's a deliberate flight of smart money toward higher returns. The wealthy approach real estate completely differently too. While average investors might dream of flipping houses or building a small portfolio of rental properties, the 1% focus on specialized commercial real estate that average investors rarely even consider. Think data centers, industrial parks, medical facilities, and logistics hubs, properties tied to unstoppable technological and demographic trends. Data centers perfectly illustrate this approach. As our digital world expands and AI technologies demand more computing power, the physical infrastructure supporting this growth must expand dramatically. Wealthy investors recognize this trend early and have been quietly accumulating ownership in these essential digital properties, while most retail investors remain fixated on residential real estate. Another key difference is access to private markets. When promising startups are in their early growth phases, long before they become household names, wealthy investors can participate through venture capital funds. By the time these companies go public, much of the exponential growth has already occurred, with the 1% having captured those gains while average investors wait for the IPO leftovers. The barriers to entry for these investments have traditionally been significant. Minimum investments for private equity funds typically range from $250,000 to $1 million, effectively locking out all but the wealthiest individuals. This exclusivity isn't accidental. It's a feature of the system that helps maintain the performance edge. What makes these alternative investments particularly valuable is their performance during market turmoil. Private equity and specialized real estate have demonstrated lower correlation with public markets, providing crucial protection when stocks take a nosedive. This explains why the wealthy sleep well during market crashes. Their diversification extends far beyond just mixing stocks and bonds. The industry has noticed this growing interest. In 2023, private equity saw record inflows, with investors particularly focused on technology and healthcare sectors. These aren't random choices. They represent calculated bets on industries expected to drive significant future returns. The wealthy also use specialized hedge funds in ways very different from what most people understand about these investment vehicles. While media coverage often focuses on short-term trading strategies, many elite hedge funds provide exposure to niche markets or unique strategies that aren't available through conventional investments. These might include merger arbitrage, distressed debt, or global macro strategies that can generate returns independent of overall market direction. Beyond financial assets, the ultra-wealthy have long recognized the value of tangible alternatives like art, wine collections, and other collectibles. While these investments might seem like mere status symbols, they often appreciate significantly while providing portfolio diversification that purely financial assets cannot match. A carefully curated art collection, for instance, can appreciate at rates that rival or exceed traditional investments, while remaining largely uncorrelated with market movements. The good news is that this alternative investment playbook isn't completely off limits to everyone else anymore. New platforms are emerging that democratize access to these previously exclusive asset classes. Companies like Yield Street are creating pathways for retail investors to participate in private equity, real estate, and other alternative investments with much lower minimum requirements than traditional channels. These platforms essentially pool capital from multiple smaller investors to reach the high minimums required for institutional quality alternative investments. While not offering the same level of access as a billionaire's family office, they represent a significant step toward leveling the playing field. The key takeaway is that the traditional financial advice most people receive creates a fundamentally different portfolio than what the wealthy actually build. This isn't just a matter of having more zeros in their account balance. It's about accessing entirely different asset classes with superior return profiles and risk characteristics. If you're serious about building wealth like the 1%, you need to start thinking beyond conventional stocks and bonds. This doesn't mean abandoning those investments entirely, but rather understanding that they should represent only one piece of a more sophisticated strategy. The wealthy aren't just better at picking stocks, they're playing an entirely different game with different assets altogether. Risk management secrets: how the 1% protect their wealth. That different game played by the 1% extends far beyond just what assets they buy. It's in how they protect them. Think the ultra-wealthy got rich by taking massive risks? Think again. The true elite use sophisticated protection strategies that create a financial force field around their wealth, allowing them to weather storms that demolish average portfolios. Warren Buffett's famous rules of investing capture this mindset perfectly. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This isn't just clever wordplay. It's the cornerstone philosophy of wealth preservation that separates extraordinary investors from everyone else. Here's what makes this approach so powerful. When you lose 50% of your investment, you don't need a 50% gain to break even. You need a 100% gain. This mathematical reality means avoiding losses is actually more important than chasing returns. The wealthy understand this asymmetry in a way most investors don't. During recent market crashes like 2020's pandemic plunge or 2022's tech sell-off, Average investors were glued to CNBC, panic selling at the bottom. Meanwhile, the ultra-wealthy were executing pre-planned protection strategies they had established long before trouble arrived. These strategies go far beyond the basic diversify your portfolio advice you've heard 1,000 times. Wealthy investors employ sophisticated hedging techniques using financial instruments that might sound complex but serve a simple purpose: creating guardrails against catastrophic losses. One powerful method is using options strategies, particularly put options that work like insurance policies for their investments. Imagine paying a small premium that guarantees you can sell your stocks at a predetermined price, even if the market crashes 30%. This protection means wealthy investors can stay invested during volatility, rather than selling at the worst possible time. This approach creates what financial experts call asymmetric opportunities, investment setups where the potential upside remains virtually unlimited while the downside risk is strictly capped. It's like having a financial superpower that lets you participate in market growth while limiting your exposure to market crashes. Take private equity investments, where the ultra-wealthy often allocate significant capital. These investments can yield exceptional returns, but the wealthy don't just throw money at them blindly. They structure these deals with careful risk protections, preferred equity positions, liquidation preferences, and board governance rights that all serve to create favorable risk-reward dynamics. Another fascinating technique is how family, offices, and institutional investors engage in scenario planning and stress testing. Rather than simply hoping for the best, they actively simulate various market conditions, recessions, inflation spikes, geopolitical crises, to assess how their portfolios would perform under different scenarios. This isn't just theoretical exercise. During the pandemic crash, those who had stress-tested their portfolios knew exactly which assets to keep, which to sell, and which new positions to establish. While others were frozen with indecision, they executed predetermined plans with calm precision. Position sizing is another critical strategy that rarely makes it into mainstream financial advice. The wealthy don't just pick the right investments. They allocate the perfect amount to each position based on risk characteristics. This prevents any single investment from causing catastrophic damage to the overall portfolio. Here's what this might look like in practice. Investments with higher uncertainty might receive just 0.5 to 1% of portfolio allocation, while more established opportunities might get 3 to 5%. This careful calibration creates a portfolio that can absorb multiple failures without threatening overall wealth. The most sophisticated investors also use stop-loss orders strategically, but not in the way most retail investors do. Rather than setting arbitrary percentage-based stops that get triggered during normal market volatility, they establish stops based on fundamental changes in their investment thesis. This prevents them from being shaken out of good positions during temporary market panics. Wealthy investors also diversify differently. While average investors might think owning different tech stocks constitutes diversification, the truly wealthy ensure their assets respond differently to various economic conditions. They own investments that thrive during inflation, alongside others that perform well during deflation or recession. Safe haven assets play a crucial role in this protection strategy. Gold, high-quality bonds, and certain real estate investments typically retain value during market downturns, providing stability when other assets are in free fall. These aren't just small defensive positions, they're strategic allocations that can preserve capital during turbulent times. For those without billions, some of these protection strategies are still within reach. Dollar cost averaging. Investing fixed amounts regularly regardless of market conditions helps manage risk by reducing the impact of market volatility. This approach allows you to automatically buy more shares when prices fall and fewer when prices rise. Accessible hedging strategies also include maintaining proper diversification across genuinely different asset classes, implementing strategic stop-loss orders, and regularly rebalancing portfolios to maintain your desired asset allocation. These fundamental techniques mirror the sophisticated approaches of wealthy investors, just at a different scale. The mindset shift is perhaps the most valuable takeaway. While most investors obsess over maximizing returns and chasing the next hot stock, The wealthy focus first on capital preservation. They understand that consistent, modest returns with minimal drawdowns create more wealth over time than volatile high returns punctuated by devastating losses. This approach requires patience and discipline. The wealthy aren't trying to double their money in a year. They're trying to steadily grow wealth while ensuring they never experience the kind of catastrophic loss that takes years to recover from. This long-term perspective allows them to make rational decisions when others are acting emotionally. The results speak for themselves. During the 2020 crash, investors who employed these risk management strategies experienced significantly smaller portfolio drawdowns and recovered more quickly than those who relied on hope alone. The same pattern repeated during the 2022 downturn, with protected portfolios maintaining
the digital
stability,
asset strategy,
while
how the
unprotected
wealthy
ones
approach
suffered
crypto
substantial
differently.
losses. Risk management offers protection during market volatility, but there's another arena where the contrast between average and wealthy investors couldn't be more striking. When it comes to cryptocurrency, forget everything you've learned from TikTok influencers. The 1% aren't gambling on dog-themed coins or pixelated monkey JPEGs. They're strategically positioning themselves in the digital asset space with an approach that's worlds apart from retail investors. What's fascinating is that, contrary to popular belief, the wealthy aren't avoiding crypto. They're embracing it. Recent data shows that 50% of relationship managers report their ultra-wealthy clients are actually increasing their exposure to digital assets. This flies in the face of the notion that serious investors stay away from cryptocurrency altogether. But here's where it gets interesting. While retail investors are chasing quick gains on trading platforms, the wealthy approach crypto with the same methodical discipline they apply to traditional asset classes. They're not day trading based on Elon Musk's tweets. They're building strategic positions designed to capitalize on the long-term transformation of our financial system. The first major difference is their focus on infrastructure. Instead of speculating on individual tokens, wealthy investors are putting significant capital into the foundational technologies that will power the entire digital economy. This means investing in data centers, computing networks, and the physical infrastructure required to process blockchain transactions at scale. These infrastructure investments are particularly appealing because they benefit regardless of which specific cryptocurrencies ultimately succeed. Think of it like investing in picks and shovels during a gold rush. You profit whether or not any individual miner strikes gold. The wealthy recognize that as digital assets and AI technologies continue to grow, the demand for supporting infrastructure will explode, with estimates suggesting this sector will require around $2 trillion in global investment by 2030. Family offices and institutional investors incorporate digital assets as part of a comprehensive portfolio strategy rather than treating crypto as a separate speculative bet. They typically allocate a carefully calculated percentage, usually between 1 to 5% of their overall portfolio, to digital assets, treating them as a strategic diversification play rather than betting the farm. What's particularly telling is that over 77% of these wealthy investors either maintained or increased their digital asset investments even amid market volatility. This steady approach stands in stark contrast to the emotional buying and selling patterns we see from retail investors, who often buy at market peaks and panic sell during downturns. Access is another crucial advantage the wealthy have in the crypto space. While average investors typically buy cryptocurrencies on public exchanges after projects have already gained significant attention, the ultra-wealthy gain entry through private token sales and early-stage venture funding opportunities. These private investment rounds often come with significant discounts to public market prices and allow investors to get in on promising projects before they hit mainstream awareness. These private deals are typically limited to accredited investors, individuals with net worths exceeding $1 million or annual incomes above $200,000, effectively creating a two-tiered system where the most promising opportunities remain exclusive to those who already have wealth. By the time retail investors hear about many projects, the wealthy have already established positions at much lower price points. The 1% also approach security and custody of digital assets with institutional-grade solutions. While retail investors might store their crypto on exchanges, which regularly get hacked, or struggle with complex wallet setups, wealthy investors employ sophisticated multi-signature wallets, cold storage solutions, and often work with specialized custody providers that offer insurance against theft or loss. This security-first mindset extends to their entire approach. Wealthy investors conduct extensive due diligence before entering the crypto space, often employing specialized advisors who understand both traditional finance and the unique aspects of blockchain technology. They evaluate projects based on fundamentals like team credentials, technology viability, governance structure, and real-world adoption potential, rather than hype or social media momentum. Perhaps most surprisingly, the ultra-wealthy are increasingly using digital assets for tax efficiency and estate planning. Cryptocurrencies offer unique advantages for wealth transfer strategies, and the 1% are working with specialized advisors to optimize their tax situations while creating structures for passing digital wealth to future generations. For example, some wealthy investors use crypto assets as part of broader tax planning strategies, taking advantage of jurisdictional differences in how digital assets are treated. Others use specific crypto structures for charitable giving or establishing trusts that can efficiently transfer wealth while minimizing tax implications. The SEC's recent approval of spot Bitcoin ETFs represents another turning point that aligns with how the wealthy approach crypto. These investment vehicles allow exposure to Bitcoin's price movements without the complexities of direct ownership. Exactly the kind of simplified, regulated access that appeals to traditional wealth management approaches. Many expect this development to accelerate mainstream adoption as it brings digital assets further into the regulated financial system. While retail investors often focus exclusively on price speculation, wealthy investors look at broader applications of blockchain technology beyond just currencies. They're investing in projects that address real-world problems in finance, supply chain management, healthcare, and other sectors, where blockchain offers genuine improvements over existing systems. The democratization of alternative investments is gradually creating more opportunities for retail investors to access crypto strategies previously reserved for the elite. New platforms are emerging that allow smaller investors to participate in early-stage crypto projects and gain exposure to digital asset infrastructure investments that were once exclusive to the wealthy. However, the knowledge gap remains significant. The 1% approach digital assets with comprehensive research teams, specialized advisors, and professional risk management frameworks, resources that most retail investors simply don't have. This information asymmetry creates fundamentally different outcomes between the two groups, even when investing in the same asset class. What can we learn from the wealthy's approach to crypto? First, focus on fundamentals rather than hype. Second, maintain appropriate position sizing. Even the wealthiest investors limit their crypto exposure to a reasonable percentage of their overall portfolio. Third, think long-term about the transformative potential of blockchain technology rather than short-term price movements. For those looking to implement similar strategies, start by educating yourself about blockchain fundamentals before investing. Consider allocating only a small percentage of your portfolio to this space, and focus on established projects with real-world utility rather than speculative tokens. Look for regulated investment vehicles that provide exposure to the broader digital asset ecosystem, and always prioritize security and proper storage of any directly held crypto assets. The data-driven advantage, moving beyond emotional investing. While understanding blockchain fundamentals is critical, there's an even more powerful divide separating elite investors from everyone else. Have you ever wondered why billionaires seem to make cool, calculated decisions while your own investments feel like an emotional roller coaster? The truth is that the ultra-wealthy aren't just working with better information, they're processing that information through sophisticated data systems that completely eliminate emotional investing. Behind the scenes, wealth management firms are quietly revolutionizing how the 1% approach their portfolios. They're not relying on hunches or hot tips. They're building entire investment strategies around behavioral finance principles, recognizing how cognitive biases can sabotage even the smartest investors. This isn't just a slight edge, it's a complete paradigm shift in how investment decisions get made. The contrast couldn't be more stark. Most retail investors make decisions based on feelings, fear when markets drop, excitement when stocks are soaring. Meanwhile, the ultra-wealthy have built systems that strip emotion entirely out of the equation. They're not trying to time the market based on CNBC headlines or Reddit forums. They're letting cold, hard data drive every single decision. What does this data-driven approach actually look like in practice? It starts with comprehensive quantitative analysis that goes far beyond the surface-level metrics most investors rely on. While average investors might glance at basic PE ratios or dividend yields, wealthy investors deploy advanced statistical models that analyze hundreds of factors simultaneously. They're looking at obscure indicators like shareholder yield, which combines dividends and buybacks, free cash flow conversion rates, and normalized earnings over full market cycles, metrics that provide a much clearer picture of a company's true financial health. These sophisticated investors don't just collect more data, they process it differently too. They're using sophisticated AI tools to understand investment patterns that human analysts might miss entirely. The technology doesn't just crunch numbers, it helps wealth managers understand client psychology and create investment strategies perfectly tailored to individual risk profiles. This combination of behavioral science and AI is creating unprecedented levels of personalization that simply wasn't possible even 5 years ago. One of the most powerful tools in the wealthy investor's arsenal is systematic rebalancing, a disciplined approach to maintaining their desired asset allocation regardless of market conditions. Unlike emotional investors who chase performance and buy high, sell low, the ultra-wealthy have automated systems that force them to do the opposite, selling portions of assets that have performed well and buying more of those that have underperformed. This contrarian approach ensures they're constantly buying low and selling high, the exact opposite of what emotional investors typically do. Tax optimization creates another massive advantage for high net worth individuals. While average investors might focus solely on pre-tax returns, the wealthy are obsessed with what they keep after taxes. They employ sophisticated strategies like tax loss harvesting that strategically realizing losses to offset gains and reduce their tax burden. They're also masters at utilizing tax-efficient investment vehicles, ensuring that assets generating regular income are held in tax-advantaged accounts, while growth investments sit in taxable accounts where they can benefit from lower capital gains rates. Factor investing represents another data-driven approach that separates elite investors from amateurs. Rather than picking individual stocks based on stories or sentiment, they identify specific characteristics or factors that have historically delivered superior risk-adjusted returns. They might target companies with low price-to-book ratios, value factor, consistent earnings growth, quality factor, or strong recent performance, momentum factor. By combining these factors strategically, they create portfolios designed to outperform regardless of market conditions. The backtesting advantage can't be overstated either. Before deploying capital into any new strategy, wealthy investors rigorously test it against historical data to understand how it would have performed through different market environments. They're not interested in strategies that only work during bull markets. They want approaches that deliver consistent results through recessions, inflation, deflation, and everything in between. This historical perspective helps them avoid strategies that might look good on paper, but would crumble under real-world conditions. Perhaps most importantly, the data-driven approach allows wealthy investors to recognize patterns that others miss entirely. When markets crashed in March 2020, most investors panicked. But those with sophisticated data systems recognize the historical pattern. Sharp, fear-driven sell-offs are typically followed by equally sharp recoveries. Their systems flag this as a buying opportunity based on quantitative triggers, allowing them to capitalize while others were frozen with fear. The integration of alternative data sources gives the wealthy another edge. They're not just analyzing traditional financial statements, They're incorporating satellite imagery to track retail parking lot traffic, social media sentiment analysis to gauge consumer opinions, and credit card transaction data to spot emerging consumer trends. These unconventional data sources often reveal opportunities months before they show up in company earnings reports. What's particularly fascinating is how this data-driven approach is becoming increasingly accessible. While institutional-grade analytics platforms once cost millions, new technologies are democratizing these tools. Today, retail investors can access sophisticated portfolio analysis, factor investing models, and even basic tax optimization strategies through affordable platforms. The playing field isn't level yet, but the gap is narrowing. For those looking to implement a more data-driven approach, start by examining your past investment decisions. Were they driven by headlines, emotions, or systematic analysis? Document your investment thesis for each position and regularly review your decision-making process. Even this simple practice can help identify emotional patterns that might be undermining your returns. Next, consider building a systematic rebalancing strategy. Set target allocations for different asset classes and commit to adjusting your portfolio at regular intervals, perhaps quarterly or semi-annually. This forces you to trim positions that have grown too large and add to those that have underperformed, essentially automating the buy low, sell high principle that's so difficult to execute emotionally. Tax optimization doesn't require millions either. Even modest portfolios can benefit from basic tax loss harvesting, selling investments that have declined in value to offset capital gains elsewhere in your portfolio. Just be careful to avoid wash sale rules by waiting at least 30 days before repurchasing substantially identical securities. The alternative investment revolution is another area where the gap is narrowing. New platforms are emerging that allow retail investors to access private equity, real estate, and other non-traditional assets that were historically reserved for institutional investors. While minimum investments on these platforms are still higher than typical stock purchases, they're dramatically lower than traditional private equity minimums, opening these strategies to a much wider audience. Remember that data-driven investing isn't about eliminating human judgment entirely. It's about using data to guide that judgment and override emotional impulses that lead to poor decisions. The most successful investors combine quantitative analysis with qualitative understanding, using data to identify opportunities, but applying human wisdom to evaluate factors that can't be easily quantified. The long game, building generational wealth, like the 1%. Ever wonder why some family names seem to be wealthy for generations, while most fortunes disappear within 3 generations? There's a fundamental shift in perspective that separates truly wealthy families from everyone else. While data analytics and AI help the ultra-wealthy make better decisions today, their most powerful advantage is actually much simpler. They operate on an entirely different timeline. The wealthy aren't playing the same game as the average investor. When you're checking your retirement account, hoping for enough to stop working at 65, the ultra-wealthy are establishing structures designed to benefit their great-grandchildren's education funds. This isn't just about having more zeros in their bank accounts. It's about a completely different perspective on what wealth actually means and how it compounds across decades. Family offices represent one of the clearest examples of this long-term thinking. These specialized management structures serve as the command centers for wealthy families, coordinating everything from investments to estate planning across multiple generations. Unlike typical financial advisors focused on quarterly performance, family offices implement strategies designed to preserve and grow wealth over 50, 100, or even 200 years. What's fascinating is how this extended time horizon completely transforms investment decisions. When you're investing for multiple generations, market volatility becomes nearly meaningless. A 30% market crash that might devastate a retiree's plans becomes merely a blip in a 75-year wealth strategy. This explains why billionaires often seem unnervingly calm during market panics. They're simply operating with a different sense of time. The math behind compound growth explains why this timeline difference is so critical. Let's be honest about what happens when we extend our investment timeline. The same investment growing at 10% annually becomes 5 times larger over 40 years compared to 20 years. And this isn't just theoretical. We can see it in action with many of today's dynastic fortunes. Take the Rockefeller family, for instance. Their wealth wasn't built through get-rich-quick schemes or lucky stock picks. It came from patient capital allocation in industries like oil and real estate that provided stable returns over many decades. Their investments were carefully structured to emphasize patience and discipline, qualities that are exceedingly rare in today's instant gratification investment culture. The same pattern appears with the Rothschilds, whose banking empire spans centuries rather than quarters. Their approach has consistently emphasized stable long-term growth over flashy short-term gains. These families don't just randomly pick investments, they develop comprehensive strategies for capital preservation and growth that operate across multiple economic cycles. But generational wealth building isn't just about making the right investments. It's about creating the right structures to protect and transfer that wealth. This is where the ultra-wealthy employ sophisticated tools that most financial advisors never mention to average investors. Irrevocable trusts stand out as one of the most powerful vehicles for multi-generational wealth preservation. These aren't just simple legal documents. They're comprehensive wealth protection systems that shield assets from excessive taxation and potential creditors while ensuring smooth transitions between generations. When properly structured, these trusts create a perpetual engine for family wealth that can literally last for centuries. The wealthy use these trust structures not just as tax shelters, but as governance systems for family wealth. They establish clear rules about how family members can access funds, what investments are permitted, and how future generations will be educated about wealth management. This systematic approach prevents the common problem of wealth dissipation that typically happens by the third generation. Speaking of education, wealthy families approach financial literacy completely differently than most households. While average families might occasionally discuss budgeting or paying for college, ultra-wealthy families systematically educate their children about money management from an early age, often starting when kids are just 5 or 6 years old. These financial education programs aren't focused on coupon clipping or saving for a rainy day. They emphasize understanding complex investment vehicles, evaluating business opportunities, and maintaining disciplined capital allocation strategies. Children from wealthy families often participate in family investment discussions and decisions starting in their teens, gaining practical experience decades before their peers. This approach creates a compound effect of financial knowledge that's just as powerful as the compound growth of their investments. By the time most people are just beginning to think seriously about retirement, heirs of wealthy families have already participated in dozens or hundreds of sophisticated investment decisions. The contrast with how most people approach investing couldn't be more stark. The average investor spends hours worrying about short-term market fluctuations, trying to time market entries and exits, and chasing the latest investment fads. Meanwhile, wealthy investors focus on creating robust, diversified portfolios designed to weather multiple economic cycles while steadily growing over generations. Think about what happens during market panics. Most investors frantically check their portfolios daily, make emotional decisions based on fear, and often sell at precisely the wrong time. Wealthy families with generational perspectives view these same market events as opportunities to acquire quality assets at discounted prices, knowing they have decades for recovery and growth. This long-term perspective also influences the types of investments wealthy families prefer. While they certainly own public stocks, they typically emphasize private equity, real estate, and other alternative investments that align better with multi-generational time horizons. These investments may be illiquid in the short term, but often produce exceptional returns over decades. The power of this approach becomes clear when we look at the historical performance of diversified portfolios over long periods. Investments in quality companies and real estate have historically yielded average annual returns of 7 to 10% over extended timeframes. When compounded over generations and protected from unnecessary taxation, These returns create the vast fortunes we associate with dynastic wealth. This doesn't mean wealthy families never take risks. Quite the opposite. Their extended time horizon actually allows them to take calculated risks on emerging technologies and industries, knowing that even if many fail, a few spectacular successes will more than compensate over time. They're playing a different probability game than investors focused on 5-year returns. The concept of patience in investing takes on new meaning in this context. For most investors, patience means not selling during a bad quarter. For wealthy families, patience means holding quality assets through multiple economic cycles, sometimes for 50 years or more. This extreme patience is precisely what enables compound growth to work its mathematical magic. Financial advisors to these ultra-wealthy families play a critical role in maintaining this disciplined, long-term approach. Unlike typical advisors who might focus on beating the market this year, these specialized advisors help families navigate the complexities of wealth transfer, prepare heirs for responsible management, and ensure family values align with investment decisions. This reveals perhaps the most important lesson from how the wealthy approach long-term investing. It's not just about making money, it's about creating a legacy that represents the family's values and vision. The most successful family wealth strategies integrate financial goals with broader family objectives, implementation blueprint, education, applying wealthy investor strategies at any level. The barriers between everyday investors and the ultra-wealthy are finally breaking down. While creating multi-generational wealth might seem like a distant dream if you're starting with thousands rather than millions, the democratization of financial tools has quietly revolutionized who can access once exclusive investment strategies. Let's build your implementation blueprint for applying these wealth-building approaches at any level. Many people assume you need a 7-figure portfolio to invest like the 1%, but that's simply not true anymore. The financial technology revolution has created a surprising shift. The same tools and investment classes once reserved for family offices are now being packaged for anyone with the right knowledge and a modest starting investment. This accessibility revolution means you can begin implementing these strategies regardless of your current financial situation. Let's start with the psychological foundation. The wealthy investor mindset doesn't require any capital to adopt. Begin by lengthening your time horizon. Instead of checking your investments daily or even weekly, commit to reviewing them monthly or quarterly. This simple shift helps you avoid emotional decision-making during market volatility. Create a written investment policy statement that outlines your goals, risk tolerance, and the rules you'll follow when making investment decisions. This document becomes your emotional anchor during market turbulence. Next, leverage technology to gain the data-driven edge. While you might not have access to the proprietary AI systems used by hedge funds, several affordable platforms now offer sophisticated analytics to everyday investors. Services like M1 Finance, Betterment, and Wealthfront provide automated portfolio management with advanced features like tax loss harvesting and automatic rebalancing for minimal fees. For more active investors, platforms like Trade Ideas and TrendSpider offer AI-powered market analysis tools starting at just $30 to $50 per month. You can even tap into institutional-grade research through platforms like Koifin and Simply Wall Street, which provide comprehensive financial data visualization and company analysis tools at a fraction of what professional terminals cost. These platforms help you make decisions based on hard data rather than emotions or headlines. To gain exposure to the megatrends driving the next decade of wealth creation, you don't need direct access to private venture capital funds. Several ETFs now track specific megatrends like AI, renewable energy, and healthcare innovation. For example, the Global X Robotics and Artificial Intelligence ETF, BOZ, and the ARC Genomic Revolution ET, provide focused exposure to cutting-edge technologies. These specialized ETFs allow you to invest in entire sectors rather than trying to pick individual winners, mirroring how wealthy investors spread their risk across emerging technologies. For those interested in sustainable energy transitions, ETFs like the iShares Global Clean Energy ETF, ICLN, offer broad exposure to companies driving the renewable energy revolution. And if you're looking to capitalize on demographic shifts in emerging markets, consider funds like the Emerging Markets Internet and E-commerce ETF, EMQQ, that focus on the digital transformation happening in developing economies. Perhaps the most exciting development is the democratization of alternative investments. Platforms like YieldStreet have revolutionized access to asset classes traditionally reserved for institutional investors, including private equity, private credit, and real estate. What's remarkable is that many of these platforms allow you to start with just a few $100s, compared to the 6- or 7-figure minimums typically required for direct investment in these asset classes. The numbers tell the story of why this matters. The alternative investment sector has nearly doubled from $7.4 trillion in 2017 to $14.7 trillion in 2022, with projections suggesting it could reach $19.6 trillion by 2028. This explosive growth is driven by investors seeking both diversification and higher long-term returns. And now you can participate in this trend even with a modest portfolio. For those interested in private market investing, platforms like Fundrise and CrowdStreet have lowered the barriers to real estate investment, with minimum investments sometimes as low as $500. Republic and Start Engine allow small investors to participate in startup funding rounds that were once exclusive to venture capitalists. Even in the private credit space, platforms like Percent and YieldStreet offer access to asset-backed loans, structured notes with minimums of $500 to $1,000. Risk management strategies can also be implemented regardless of portfolio size. Dollar cost averaging is a powerful technique where you consistently invest a fixed amount at regular intervals, regardless of market conditions. This approach automatically has you buying more shares when prices are low and fewer when prices are high, effectively managing market volatility without requiring any complex analysis. Diversification remains one of the most effective risk management tools available to all investors. While you might not be able to invest directly in 50 different alternative asset classes, you can still achieve meaningful diversification across stocks, bonds, real estate, and alternatives through ETFs and mutual funds. Modern portfolio theory suggests that proper diversification can significantly reduce portfolio volatility without necessarily sacrificing returns. For more active risk management, even modest portfolios can implement strategic stop-loss orders based on fundamental changes rather than arbitrary percentages. This approach focuses on protecting capital when the investment thesis changes, not just when prices fluctuate. Additionally, maintaining a small allocation to uncorrelated assets like gold ETFs or Treasury inflation-protected securities, TIPS, can provide ballast during market downturns, mimicking how wealthy investors use safe haven assets. Private equity strategies are no longer out of reach either. While direct participation in traditional private equity funds typically requires significant capital, newer investment vehicles like interval funds and business development companies, BDCs, provide exposure to private companies with much lower minimums. These structures allow everyday investors to gain access to private market returns that were previously exclusive to institutional investors. For sophisticated investors looking to create asymmetric opportunities, option strategies can be implemented even in modest accounts. Basic protective puts can be purchased to limit downside risk on core positions, while covered calls can be written to generate additional income. These strategies don't require massive capital, but do require education. Fortunately, many brokerages now offer free educational resources on options trading. The key to successfully implementing these strategies is starting small and scaling up as your knowledge and comfort grow. Don't try to implement everything at once. Instead, begin with the psychological principles, then gradually incorporate the investment strategies that align with your goals and risk tolerance. Remember, many of the ultra-wealthy built their fortunes through patience and consistent application of sound principles, not overnight speculation. As we reach the end of our journey into the investment strategies of the 1%, there's one fundamental truth that stands above all others: the patience and discipline to delay gratification. While most people chase immediate pleasures, the wealthy have mastered the art of postponing today's wants for tomorrow's greater rewards. This isn't just about knowing the right moves. It's about having the psychological strength to stick with them through market turbulence. The research shows it clearly. Disciplined investors who maintain a long-term perspective consistently outperform their emotionally driven counterparts. They're playing a completely different game. Remember, you don't need to transform your entire financial life overnight. Start by adopting the wealth mindset first, the ability to think in decades rather than months. Then implement one strategy at a time as your knowledge grows. Like many self-made billionaires who began with modest means, your path to financial success begins with a simple decision: to approach money differently than those around you. Make that choice today, and your future